On January 26, 2026, spot gold crossed $5,000 per troy ounce for the first time in history. Within days, it had touched $5,306. By late January, it reached an intraday high of $5,608. These are not numbers that any mainstream financial forecast was printing 2 years ago, and yet here we are, staring at a metal that has gained 64% in 2025 alone, its biggest annual gain since 1979, and has now doubled in value over the last 18 months. The $5,000 milestone is significant for reasons beyond the round number. It represents the moment when gold stopped being a tactical hedge and started being repriced as a structural cornerstone of global portfolios. Central banks are buying it at a pace not seen since before the Bretton Woods era. Retail investors in Asia and Europe are rushing to build personal holdings for the first time. Western ETF inflows hit $89 billion in 2025, the largest on record. And institutional investors who spent the last decade treating gold as an irrelevant relic are quietly rebuilding positions. Something has changed. This article explains exactly what and what it means for how you should be positioned right now. The seeds of the $5,000 breakout were planted in 2022 when the United States froze Russia's foreign exchange reserves following the invasion of Ukraine. That decision, using the dollar as a geopolitical weapon, sent a chill through central banks worldwide. If dollar-denominated reserves could be frozen by executive order, then the calculus of reserve management had to change. China's central bank began buying gold in earnest, extending its streak to 14 consecutive months through 2025 and accumulating over 2,303 tons. Poland, Turkey, Brazil, Kazakhstan, and a wave of emerging market central banks followed. Central bank purchases averaged 80 metric tons per month through 2025, a pace that created a structural supply-demand imbalance the market had never experienced before. The acceleration into 2026 was driven by a second wave of catalysts. The military escalation involving the United States, Israel, and Iran in late February sent crude oil through $120 per barrel, reigniting inflation fears precisely when central banks had hoped to declare victory. The White House's repeated attempts to pressure Federal Reserve Chair Jerome Powell, including threats of criminal indictment and the opening of a Justice Department investigation, shook global confidence in the independence of the world's most important monetary institution. A diplomatic rift at Davos, reports of middle-power nations seeking gold-backed trade settlement alternatives to the dollar, and the general sense of a fracturing world order combined to create the conditions for gold's final surge through $5,000. The first and most powerful buyer category is central banks. JPMorgan's global research team projects approximately 190 tons of central bank purchases per quarter in 2026, elevated by historical standards but slightly below the peak of recent years, simply because at $5,000 per ounce, central banks need fewer tons to achieve the same dollar value allocation target. This demand is structural, not tactical. It reflects a fundamental reassessment of reserve management by nations that have watched dollar reserves weaponized and concluded that gold offers a form of financial sovereignty that no other asset can match. The second category is the global retail investor, and this is where something genuinely new is happening. Adrian Ash, a precious metals analyst, captured it well. A wave of first-time buyers across Asia and Europe is driving a surge in personal gold holdings. These are not sophisticated institutional traders managing basis risk. They are ordinary savers in countries with long cultural memories of currency failure, who are watching inflation, geopolitical instability, and government debt levels and concluding that physical gold is the most honest store of value available to them. Bar and coin demand is on track to exceed 1,200 tons annually, among the highest levels ever recorded. The third category is Western institutional investors via ETFs, and this is the buyer category that had been largely absent from the gold rally until recently. Global gold ETFs witnessed their strongest year of inflows on record in 2025, with $89 billion flowing in and total assets under management doubling to $559 billion. Physical holdings reached 4,025 tons, a historic peak. December 2025 marked the seventh consecutive month of positive global ETF flows. When Western institutions start allocating systematically rather than tactically, gold's demand base becomes genuinely diversified and durable in a way it has never been before. For decades, investors used a simple model to think about gold. When real interest rates rise, gold falls because the opportunity cost of holding a non-yielding asset increases. That model worked reasonably well from 2008 through 2021. It has been comprehensively broken since 2022. Gold has made record highs in environments of elevated real rates, rising real rates, and falling real rates because something more fundamental than rate differentials is now driving demand. Business Insider characterized it as a debasement trade, a rush into hard assets tied to debt and fiscal anxiety. CME Group noted that gold is making record moves even during periods of elevated real yields, suggesting investors are assigning greater weight to sovereign diversification and geopolitical hedging than to yield relationships. The deeper shift is what some analysts are calling the multipolarity premium, the repricing of gold to reflect a world in which the dollar's reserve currency status is being actively challenged. Sovereign debt is at historically extreme levels in virtually every advanced economy, and the independence of central banks from political interference can no longer be taken for granted. None of these conditions are likely to resolve quickly. Goldman Sachs explicitly assumes that hedges against global macro policy risks will remain stable through 2026 and beyond, not because they are being pessimistic, but because the structural forces driving them are not the kind that a single policy announcement or diplomatic agreement can reverse. The Wall Street consensus on gold for 2026 is broadly bullish, but the range of forecasts reflects genuine uncertainty about how far and fast the rally can extend from here. JPMorgan is the most aggressive, having raised its year-end 2026 target to $6,300 per ounce after gold's January breakout, a forecast based on 800 tons of projected central bank buying and continued ETF inflows. Deutsche Bank's head of metals research maintained his $6,000 target even through gold's brief but violent correction in early February, characterizing the pullback as a tactical move rather than a structural shift. Goldman Sachs is more measured, raising its December 2026 forecast to $5,400 from $4,900, noting that macro policy hedges have become sticky, meaning the structural demand drivers are not the kind that unwind quickly. UBP forecasts $5,200. The more cautious voices, HSBC, Standard Chartered, warn that the rally has been too fast and that a correction to $3,775 cannot be ruled out if geopolitical tensions ease or the Fed is forced to defend the dollar aggressively. As of April 2026, spot gold is trading around $4,676, already off its January peak of $5,608, suggesting the correction the bears warned about has begun, though it remains well above pre-breakout levels. No asset moves in a straight line, and gold's historic run has created conditions where even genuine bulls need to understand the reversal risks. The most straightforward negative scenario is a genuine reduction in geopolitical tension. If the Iran conflict resolves, Middle East stability improves, and US-allied relationships normalize, the safe haven premium in gold would shrink. The World Gold Council explicitly warns that a successful outcome from current policies could accelerate economic growth and reduce geopolitical risk, leading to higher rates and a stronger US dollar, pushing gold lower. The second risk is a more aggressive Federal Reserve response to inflation, not the gradual cuts markets are pricing, but a sharp reversal back toward tightening to defend dollar credibility. A stronger dollar historically suppresses gold by making it more expensive for non-dollar buyers. Third, positioning risk is real. After a 64% gain in 2025 and another 20% plus early in 2026, speculative long positions in gold futures are at elevated levels. If a sufficient number of leveraged traders decide simultaneously to take profits, the resulting liquidation could create a sharp but temporary correction, similar to the February 2026 episode when gold dropped from above $5,000 to $4,400 in days before recovering. That was described by Deutsche Bank as only the third such instance in the past 50 years. For investors who do not currently hold gold, the question of is it too late deserves a nuanced answer. At $4,676 today, down from the $5,608 peak, gold has corrected nearly 17% from its all-time high. Whether that correction represents a buying opportunity or the beginning of a more extended pullback depends on your view of the structural drivers. If you believe the geopolitical and monetary factors driving gold are genuinely multi-year in nature, which the balance of institutional evidence suggests, then current levels represent a more attractive entry than the January peak. If you believe tensions will resolve and the Fed will successfully normalize, then caution is warranted. For vehicle selection, the choice is split broadly by priority. Physical gold, bars, coins, allocated accounts provides the most direct exposure and is particularly relevant for investors concerned about systemic financial risk. Gold ETFs like GLD or IAU provide the simplest liquid exposure for most investors, with tight bid-ask spreads and daily liquidity. Gold mining stocks offer leveraged exposure. Their earnings grow faster than the gold price in a bull market, but they also carry operational and management risks that pure gold exposure does not. Royalty and streaming companies like Royal Gold, Wheaton Precious Metals, and Franco-Nevada offer an intermediate option, leveraged to gold prices with less operational risk than mining companies, and with diversified exposure across multiple mines and geographies. Gold at $5,000 is a milestone, but it is not a ceiling. The structural forces that drove it here, central bank de-dollarization, sovereign debt anxiety, geopolitical fragmentation, and a fundamental reassessment of what risk-free means, are not going to resolve in a quarter or a year. JPMorgan's $6,300 target may prove conservative if any of the tail risks in the current geopolitical environment materialize. The bear case of $3,775 requires a swift and comprehensive resolution of tensions that most analysts consider highly unlikely in 2026. What gold at $5,000 most clearly signals is that the world has changed. The post-Cold War international order, the unquestioned primacy of dollar-denominated assets, the assumption of central bank independence, the idea that diversified equity and bond portfolios are sufficient for all conditions, all of these foundations are under more stress simultaneously than at any point in the post-Bretton Woods era. Gold is not a prediction about the future. It is a hedge against uncertainty uncertainty about which version of the future we are actually heading into. At $4,676 today, after a 17% correction from its peak, that hedge is more accessible than it was 3 months ago. The question is not whether you should have some. At this point, the more pressing question is how much.